The anatomy of financial drag in South Florida. The South Florida housing market is currently navigating an unprecedented structural transformation. For decades, traditional market participants operated under the foundational assumption that regional real estate value was a linear product of geographic expansion, localized demand spikes, and standard aesthetic appeal. However, as we move through the mid 2020s, that legacy underwriting model has completely collapsed. The contemporary real estate ecosystem across Miami, Dade, Broward, and Palm Beach counties is now governed by an invisible, multi layered matrix of operational friction that functions as a silent capital vacuum, systematically draining liquid reserves from unsuspecting homeowners. To truly comprehend the scale of this capital erosion, one must first dismantle the illusion of the static real estate asset. In traditional retail consumer culture, a primary residence is viewed as a passive monument of personal wealth, a sanctuary where equity grows organically over time, independent of structural mechanics or atmospheric dynamics. This psychological comfort trap is precisely what blinds the average retail buyer to the true operational physics of the South Florida grid. A home in this region is not a passive monument. It is an active, open air mechanical system that exists in a state of continuous chemical, thermodynamic, and mechanical friction with one of the most aggressive environmental corridors on the planet. When you purchase real estate in South Florida, you are not merely buying a specific square footage or a set of aesthetic finishes. You are underwriting an ongoing engineering contract with the environment. Every square inch of the building envelope, from the chemical composition of the subterranean concrete footings to the polymer chains within the roof membranes, is subject to a relentless process of degradation that operates outside the visibility of the standard retail inspector. This mechanical drag creates a continuous baseline expenditure requirement that retail buyers completely omit from their forward looking financial projections. They calculate the principal, the interest, the baseline real estate taxes, and perhaps a superficial maintenance buffer, believing they have mapped out their financial future. In reality, they have stepped onto an operational treadmill that accelerates exponentially over time. This phenomenon represents a profound structural divergence between perceived equity and actual liquidity. On paper, a homeowner in a high density suburban corridor like Fontainebleau or an affluent master planned community in Weston may see their estimated property value climbing or plateauing at an impressive nominal figure. This paper equity creates a false sense of financial security, a psychological buffer that encourages further consumer spending and capital stagnation. However, when you look beneath the surface of the ledger, the real world operational cash flow required to sustain that asset is aggressively cannibalizing the homeowner's true disposable liquidity. The hidden problem is not a single isolated expense item that appears as a clear line on a monthly bank statement. If it were that simple, the retail market would have already adjusted its pricing structures to compensate for the risk. Instead, it is an interconnected web of microtransactions, deferred structural liabilities, localized regulatory revisions, and invisible mechanical compounding that works in total silence. It is the sudden, non-linear escalation of specialized community assessments. It is the micro fissure within an unreinforced concrete tie beam that slowly oxidizes internal steel rebar over a 7-year cycle. It is the creeping inefficiency of an HVAC system fighting a rising baseline humidity index that forces compressor units to run 20% past their engineered tolerance thresholds. This structural capital drain transforms what should be a wealth generating vehicle into a high drag capital anchor. The financial drag coefficient of these hidden liabilities is so severe that it can completely paralyze a homeowner's investment velocity. Money that should be diverted into secondary cash printing infrastructure pods, equity markets, or private capital deployment is instead consumed by the insatiable maintenance appetite of a single primary structure. The home ceases to function as a foundation for economic sovereignty and instead becomes a liability mask, an elite facade that hides an aggressive daily bleed of liquid net worth. The deconstruction of risk mitigation. The contemporary property insurance landscape in South Florida has evolved past a standard operational expense line item. It has transformed into an aggressive, unpredictable risk matrix that holds absolute sovereignty over property valuations and homeowner liquidity. For generations, real estate investors viewed property insurance as a passive, fixed utility, a standard safety net required by mortgage underwriters that remained relatively stable from year to year. In the current market environment, however, property insurance has become the single most disruptive economic force on the regional grid, operating as a primary engine of the hidden capital drain. To understand why the insurance ecosystem has experienced this nonlinear destabilization, one must look at the structural mathematics of reinsurance and climate underwriting. Insurance companies do not hold the entirety of their risk portfolios on their own balance sheets. They rely heavily on the global reinsurance market, a highly sophisticated international network of capital allocators that insures the insurance companies themselves against catastrophic multi-billion-dollar loss events. For global reinsurance desks operating out of London, Zurich, and Bermuda, South Florida represents one of the highest concentrations of catastrophe risk exposure on Earth. As global catastrophe losses have escalated across multiple continents, these international reinsurance syndicates have systematically repriced the cost of capital. This macro repricing of global risk hits the South Florida grid with brutal precision. Local insurance underwriters are hit with exponential increases in their baseline reinsurance costs. To maintain solvency and satisfy the strict capital reserve requirements mandated by rating agencies, these local carriers are forced to pass these expenses directly down to the consumer level. This manifests as the sudden, shocking premium escalations that have become a standard feature of property ownership in Miami-Dade, Broward, and Palm Beach counties. Annual premium increases of 20, 30, or 40% are no longer anomalies. They are the new structural baseline. The most dangerous manifestation of this risk-shifting strategy is the proliferation of separate windstorm and hurricane deductibles. In a standard retail insurance policy outside of disaster-prone regions, a homeowner pays a fixed, predictable dollar deductible, such as $500 or $1,000 per incident. In South Florida, windstorm deductibles are calculated as a percentage of the property's total insured structural value, typically ranging from 2 to 10%. Consider a standard mid-market suburban home with an insured structural replacement value of $500,000. A 5% hurricane deductible means that if a convective wind event or tropical system compromises the structure, the homeowner must personally fund the first $25,000 of structural repairs out of their own liquid cash reserves before the insurance company pays a single dollar. This creates a massive unhedged capital liability that the average retail homeowner is completely unequipped to manage. On paper, they believe they are fully insured against environmental risk. In reality, they are self-insuring for tens of thousands of dollars of primary structural damage. This hidden liability completely undermines the financial security of the asset. This is the structural reality of modern risk mitigation in South Florida. You are paying exponentially more money for a product that covers significantly less risk, creating a compounding cash drain that operates with total asymmetric efficiency against your net worth. The material life cycle ultimatum. In the modern South Florida real estate grid, Property insurance underwriters have effectively assumed the role of aggressive building inspectors. They are no longer passive collectors of risk data. They are actively dictating the material life cycles of private property through non negotiable policy mandates. Homeowners across the region are discovering that their structural components are no longer allowed to age naturally according to their technical wear thresholds. Instead, they are being forced to adhere to artificial, highly compressed life cycles mandated by insurance risk algorithms or face immediate non renewal and subsequent mortgage default. The subtropical degradation envelope. The physical degradation of real estate in South Florida is governed by immutable laws of chemistry and thermodynamics that operate with absolute indifference to the nominal purchase price of a property. The region's geographic position creates a unique, hyper aggressive ambient environment that functions as a continuous chemical reactor, attacking the physical integrity of every building material deployed on the grid. This phenomenon, forensically defined as the subtropical degradation envelope, represents a constant, compounding maintenance liability that systematically drains homeowner wealth through accelerated depreciation of the building infrastructure. The primary chemical catalyst within this degradation envelope is the extreme baseline relative humidity combined with high ambient thermal energy. In submarkets across Miami-Dade and Broward counties, the indoor and outdoor mechanical systems are forced to operate in an environment where the relative humidity routinely hovers between 70 and 95% for consecutive months. This moisture saturated air is not chemically inert. It is heavily charged with dissolved oxygen, organic fungal spores, and in proximity to coastal boundaries, highly reactive sodium chloride ions. The air conditioning vortex. In the unique environment of South Florida, the heating, ventilation, and air conditioning system is not a discretionary comfort amenity. It is the primary life support system of the building structure and the absolute heart of the property's operational expense profile. The HVAC system functions as the primary line of defense against the subtropical degradation envelope, working nonstop to regulate indoor thermal energy and compress relative humidity below the critical 60% threshold where destructive microbiological activity begins. This continuous operational demand transforms the HVAC network into an aggressive capital vortex, draining homeowner wealth through high electrical consumption loads and short cycle mechanical failures, concrete deficits, and foundation erosion. The foundational bedrock of the South Florida real estate economy is built upon concrete, from the high-rise residential towers lining the coast to the endless expanses of single-family suburban tract homes in Tamarack and Coral Springs. Poured concrete and concrete masonry units comprise the structural skeleton of nearly every building on the grid. This material selection is driven by the structural requirement to withstand extreme lateral wind load pressures during major tropical events. However, concrete possesses a severe hidden economic deficit. It is highly susceptible to chemical and physical erosion when placed in continuous contact with South Florida's volatile subterranean hydrological matrix. To understand the mechanics of foundation erosion in this region, one must analyze the unique characteristics of the local water table. South Florida sits atop a highly porous limestone shelf that functions as a massive, unconfined aquifer. The subterranean water table is extraordinarily shallow, often sitting just a few feet below the surface of the soil. This water table is not static. It exists in a state of constant dynamic fluctuation driven by seasonal precipitation cycles, regional canal management operations, tidal movements, and long-term sea level shifts. Embedded system obsolescence. A home is a complex matrix of embedded infrastructure networks, plumbing, electrical, and mechanical delivery systems, that are permanently cast inside the core concrete and structural framework of the building. In the legacy building stock of South Florida, constructed during the housing booms of the late 20th century, these embedded networks are now reaching the absolute terminal limit of their engineered material life cycles. This phenomenon, defined forensically as embedded system obsolescence, represents a massive looming financial liability that is currently detonating within the balance sheets of unsuspecting homeowners across the region. The most severe manifestation of this infrastructure collapse is found within the subterranean waste management and sanitary sewer lines of older suburban homes. Prior to the mid 1970s, residential building codes across Florida permitted the widespread installation of cast iron pipes for under-slab sewer lines. At the time, cast iron was viewed as the industry standard for durability. However, building science has since proven that cast iron possesses a catastrophic vulnerability to subsurface chemical degradation when exposed to the highly corrosive, sulfur-rich soil and fluctuating water tables of the South Florida grid. The deflation of the desirability premium. The real estate market of South Florida has long been driven by the concept of the desirability premium, an artificial pricing inflation applied to specific neighborhoods based on superficial cultural cachet, proximity to trendy lifestyle epicenters, and heavily marketed master planned brand concepts. Submarkets such as Brickell, the coastal strips of Fort Lauderdale, and elite enclaves within Weston have historically commanded immense pricing premiums from retail buyers eager to acquire the prestigious South Florida lifestyle aesthetic. These buyers willingly take on massive debt loads and pay extreme premiums per square foot, believing that desirability functions as a permanent ironclad hedge against economic contraction. As we navigate the macroeconomic realities of May 2026, this desirability premium is undergoing a severe structural deflation. The core driver of this reset is the inexorable rise of localized operational friction, which operates with absolute indifference to neighborhood prestige. A wealthy individual who pays a premium to acquire a luxury high-rise condominium in a trendy coastal zone or a sprawling estate in an exclusive suburban enclave is discovering that their elite zip code does not insulate them from the hidden capital drain. In fact, due to the high density and structural complexity of these premium developments, the velocity of the capital bleed is often significantly accelerated. The Fontainebleau logistical exploitation. As institutional capital and sophisticated allocators execute a strategic retreat from hyper-leveraged, high-friction luxury corridors, a powerful sub-market arbitrage window has opened within the high-density suburban core of Miami-Dade County. The primary epicenter for this tactical play is Fontainebleau, a submarket that represents the absolute antithesis of the cosmetic lifestyle premium, yet possesses some of the most robust, defensive, logistical fundamentals on the South Florida grid. Fontainebleau is historically viewed by the retail real estate community as a mid-tier, blue-collar residential hub. It is characterized by dense configurations of garden-style condominiums, townhome subdivisions, and closely packed single-family tracts constructed during the housing booms of the late 20th century. Because it lacks the superficial aesthetic appeal of coastal ridges or the manicured master plan branding of luxury inland suburbs, the retail market has systematically priced Fontainebleau at a significant discount per square foot. The Weston structure insulation blueprint. While Fontainebleau represents the ideal high-density workforce rental arbitrage play, the upscale suburban submarket of Weston requires an entirely different, highly specialized portfolio architecture strategy. Weston was engineered from its inception as a premier, master-planned corporate sanctuary, a highly insulated suburban enclave characterized by strict architectural zoning mandates
pristine manicured aesthetics, and exceptional public infrastructure systems. Because of these premium lifestyle indicators, Weston commands a significant pricing premium from affluent family demographics seeking a secure, highly predictable environment. However, beneath the pristine veneer of Weston's master plan subdivisions lies the exact same physical reality that governs the rest of the subtropical grid. The material life cycle clock is running out on the legacy building stock. Many of the premium single-family estates within Weston's exclusive gated communities were constructed during the development booms of the 1990s and early 2000s. These homes are now crossing the critical 20 to 30-year operational threshold where their primary embedded infrastructure networks, mechanical air conditioning matrices, and roofing envelopes are reaching terminal material exhaustion. The deployment of the underwriting mode, the definitive separator between an amateur retail property speculator and an institutional-grade portfolio architect, is the possession and execution of an underwriting moat. An underwriting moat is not a physical structure or a specific pool of capital. It is a highly disciplined, data-driven analytical matrix that governs every single transaction in your real estate ecosystem. It is a systematic process of risk exclusion that ensures you never allocate a single dollar of liquid capital into an asset encumbered by hidden structural liabilities, regulatory drag vectors, or terminal material life cycles. In the volatile environment of modern South Florida, your underwriting mode must function as a ruthless filter, automatically eliminating properties that fail to satisfy strict financial and mechanical performance thresholds. The foundation of this mode is built upon the total eradication of assumptions.
The era of passive, emotional real estate investing in South Florida is permanently over. On the contemporary grid of May 2026, survival and profitability belong exclusively to those who replace traditional retail optimism with clinical, data-driven underwriting. From structural integrity reserves to actuarial insurance models, every variable must be forensically audited to protect liquid reserves and maximize passive equity. If you are ready to stop buying the superficial retail narrative and start architecting a bulletproof property portfolio based on raw infrastructure truth, you need to align with capital professionals who respect technical precision. Don't navigate this volatile regulatory landscape in isolation. To continuously monitor infrastructure shifts, policy updates, and market anomalies across Fontainebleau, Weston, Tamarack, Coral Springs, and coastal Fort Lauderdale, make sure you are locked into our channels. Follow our profiles across all social media platforms to secure real-time, high-density data updates before the general market reacts. Drop your insights and analytical questions in the comments below. We actively review your feedback to dissect the specific corridors you want us to audit next. Share this content with sophisticated investors who refuse to let deferred maintenance liquidate their financial future. We are the South Florida Home Finder team. Secure the data, underwrite the grid. We will see you on the next high impact briefing.